fine. Before we jump in, Peter, always great to see you. How you doing today?
Hey, good. I'm doing well. I've had a little mix of everything today. Matt and I had a ETF kind of screener and research page discussion. Troy and I talked about fundamentals being blended together with technicals, and now we're back for buying calls. So I feel like I'm hitting all bases. But after a win over the weekend for the Cowboys, got to watch a little bit of football. I'm sure you did as well, either NFL or college styles, both. Hopefully you got some rest as well and are having a good Monday so far.
So far, so good. Can't really complain. And then, of course, being able to talk about options is one of my favorite things. So, not a bad way to end the day too. But here, let's jump in and kind of just get an idea of what it is that we want to discuss today. But essentially, what we're going to do is talk about from the perspective of option buying. We're going to talk about buying calls. We'll talk about some scenarios, what we should be thinking about when we're doing that. But before we do, I just really want to take a moment to review some of the basic options, option basics, I should say, just to kind of make sure that we're all on the same page and we're all talking about the same thing. So let's start with the premium components, because I do think this is a very important element of the option experience, and certainly one we should certainly make sure we have an understanding of. When we talk about option pricing, we're basically talking about six elements. We're talking about the price of the underlying, the strike price, the timed expiration, the volatility, and then we also have dividends and interest rate. Now, I'm going to ignore interest rate and dividends for now, only because interest rates is not really a tradable metric, or at least not a tradable Greek for options, unless you're strictly trading long-term options, then maybe. And of course, dividends, not every stock has a dividend. So let's just stick to these four basics, which are underlying strike price, timed expiration, and volatility. When we are talking about the premium of a particular option, it's made up of two elements. And those elements are the intrinsic value and the extrinsic value. Now, when we say intrinsic, all we're talking about is how much is it in the money, right? In other words, intrinsic value is simply decided by or made up of the underlying price and the strike price. For example, let's say we hold a 100 call, but the underlying is actually trading at 105. That means that that option has $5 worth of intrinsic value, the difference between the strike price and the underlying. The other side of that is that extrinsic value. Now, remember, I said there are four main elements to option pricing. We just discussed the fact that intrinsic is underlying price and strike price. Extrinsic is made up of that time value and that volatility component. Um, so, what that means is, let's say, for example, we get back to that same option, that 100 call when the stock is trading at 105. Maybe that option actually cost $7.50. So, what does that mean with regards to options? Well, it means that it has that $5 of intrinsic value. We already talked about that, right? That 105 minus 100. That means the other that's left over, that $2.50, is the extrinsic value, right? That time value versus as well as that implied volatility. If all else being equal, if everything stays where it's at as expiration approaches, then we know that that extrinsic value has to be taken out of that option, right? It's a decaying asset. It's going to expire at some point. And if we stay at 105 through expiration, that option is going to end up with simply intrinsic value of $5, no extrinsic value. So those are the two components that go into an action, the option premium, the intrinsic and the extrinsic value. So hopefully that makes sense. That jogs your memory a little bit. And we talk about basic positions, right? So when we're trading options, we've got basically two contracts. We've got a call and a put. And with those both, we can build a position that is bullish or bearish. So from a bullish standpoint, the long call as well as the short put would be bullish type of trade. So we're going to focus, of course, on long calls today. But technically, if you were bullish, you could look at a short put situation as well. On the other side, if you're talking about a bearish, of course, that would be a long put, but also technically a short call would be bearish as well. Depending on your level of options knowledge and depending on your rank, your tier of option trading, these may or may not be available to you, but certainly a long call and a long put are, and we're going to focus in on long calls today, which again is a bullish strategy. So let's get into that. All right, when we're talking about buying a call, let's take a look at a scenario here. So in this situation, we're saying that XYZ is trading at $42 a share. As far as the market forecasts go, you've done your research, you've decided, you know what, I like this stock, I'm bullish on it. However, I don't necessarily want to go out and buy 100 shares at $42 a share. That's not the kind of money I want to put into this particular play. I'd like to be able to participate in the upside without actually having to pay that much to control 100 shares. So, what is your action? You've decided that, hey, at this point, I can look at buying a XYZ April 42.5 call for $2.10. Now, that's the contract price of the option, $2.10. If we want to figure out what it's going to actually cost us in dollar value, we always take the option, the premium, that price that we're showing, that $2.10, multiply it by 100 to represent 100 shares, and then multiply it by however many contracts. So in this case, we're going to stick to one contract. So it's $2.10 times 100 times 1, which gives us that $210. That's the amount we're paying, the premium we're paying for this particular call. So what is it that we know about buying options, and specifically in a scenario of buying a call? What does our risk look like? Well, we didn't want to go through the process and buy 100 shares of XYZ at $42 a share because we didn't really want to have at risk $4,200. Now, the stock could technically go to zero. And that being the case, we would lose that full investment. However, now we can actually buy a call for $210, have the same type of exposure as we would with 100 shares of XYZ. What is our risk here? Well, our risk is our premium. We paid $2.10 or $210 for the position. If nothing happens and it goes to zero, or I'm sorry, if nothing happens and the stock moves lower, we are going to lose that $210. But that's the most we'll lose. So even if it goes much lower, our exposure is that $210 as opposed to the $4,200 we'd have to pay for the shares of stock. So let's take a look at this in a table format, a little bit easier to understand at that point. All right, so here we have our scenario. We bought that one XYZ April 42.5 call at $2.10. Now, the first thing we'll look at is 42.5. So what if that option or that underlying stops right at $42.5 a share? Well, we paid $2.10 for the option, and at the value at expiration will be zero because it's landed right on the strike, 42.5, 42.5. So that has no value, which means we'll lose our full $2.10. That being the case, if it moves lower to 40 or 37.5, you'll notice that that's it, right? That's the most we're going to lose. Our $2.10 for their option cost. The value of that option is still zero, and we lose $2.10. So this is part of the allure of buying a call option as opposed to the underlying itself, because we're limiting our risk. We have a clear understanding of what it is that we're risking. If we are wrong and the stock moves lower for whatever reason that may be, the most we will lose is $2.10. Now, obviously, we have the ability to act on that prior, and we hopefully, before we even put the trade on, we have an exit in mind where we don't lose the entire $2.10, $210. But again, the most we could lose would be $210. Now, let's think about it going the opposite direction. What if it goes up? Well, the first thing we have to factor in is what's called the break even. What does that mean? Well, that just simply means at what point do you not lose anything on the trade? You just break even. It's a zero-sum game. And that point is whatever the strike price is, that 42.50, plus the premium you paid, that $2.10. So if we add those together, we'd find out that 44.60 would be our break even. And if we work through that table and the math, we can see why that is. The option cost was $2.10. Now at expiration, it's actually worth $2.10 because 42.50 or 44.60 minus 42.50, $2.10. That's a break even. We have not lost or made any money on this particular trade. We just got out of it as a scratch. If we go up from there, then we start to participate. So 210 is still the cost. Now it's actually worth $2.50. So we've made 40 cents. At 50, again, the cost is the same, $2.10. The value at expiration now is $7.50, right? 50 minus 42.50, $7.50. So now we've actually made $5.40. Now we start to participate one for one with the stock as it moves up, making money on that particular option. What does that look like graphically? Well, let's take a look. This is an expiration graph of a long call. As you'll notice, the strike price is 42.5. That is where the chart starts to bend. Of course, anything below that is a loser. We lose that $2.10 or that $210 premium we paid for the option itself. But now as we go up, we start to make money. You'll notice it crossed zero at some point. What is that point? That's the break-even point, right? So we remember we talked about 42.50 strike price plus $2.10 gives us 44.60. You can see crosses right here at 44.60. That's when we are at break even. And then of course, above that, we start to make money on that position. So that is a long call position. Again, the idea here is, well, a couple of things. We get to limit our risk, or at least quantify our risk up front. We know that we could lose up to $210 on this particular trade. And we also know that we need to get above 44.60 for us to actually start making money. But then from there, we'll make money one for one as the stock continues to move. So buying stock versus buying a call. Here's a couple of important distinctions. And I think that when we talk about buying a stock, as we talked about previously, we will have more substantial risk of capital. The stock could technically go to zero. Obviously not every stock goes to zero before an option expiration, but it could happen. And so that is a substantial risk of loss. $4,200 in our previous example for $4,250 versus the $210 you paid for the option contract. Pretty substantial difference in potential risk. Lower break even point, because when we buy a stock, if we paid $42.50 for it, that's our break even, right? Hopefully, with the stock, it either goes up or down. Hopefully, it goes up for us if we were to be a purchaser of that stock, and the break even point is simply what we paid for it. On the other hand, when you're buying a call, you've got leverage with risk limited to that premium paid. In other words, we're controlling essentially 100 shares, but we only paid $210 to do so, not $4,250. The downside, of course, is that there's a higher break-even point. We needed to get to 44.60 just to break even, but above that, we start to make money, which is great. Of course, limited life, and of course, that value generally decreases with time. Typically, when you see that time value start to accelerate, is in that 30 to call it 45-day window, 30 to 60-day window, perhaps. That's when things start to accelerate. So make sure that whatever it is that you're doing with this position, that it matches up with your outlook, right? If you're looking for something to be playing out over the course of the next, 2 or 3 months, maybe not trading a 30-day option is the best choice there, right? It doesn't really match what it is that you think will happen. And of course, on the opposite side, if you are trading a shorter dated option, you need to make sure that what you expect to happen happens quickly, because it has to offset that accelerating time decay that you'll see in that 30-day window. So those are some things that we have to keep in mind. Again, when we're buying a stock, it's pretty straightforward, right? It's up or down. We're hoping that if we buy a stock, it goes up. But with an option, we have to consider not just the pricing underlying, we have to think about that timed expiration and how that's going to factor in to the value of that option. In addition, we have to also think about those volatility levels, which is outside the scope of today's conversation, but it is a factor in option pricing that we have to consider. So a lot more goes into the thought process of buying a call option versus buying a stock, but you can see some of the benefits and the reasons why someone would look to buy a call versus the actual outright. All right, so I've said a few things here about the basics of buying calls, Peter. Anything you want to add before we move on from this point?
Yeah, maybe so, or at least just to kind of piggyback off of a lot of what you said. And I think that this slide says a lot, because especially when we've got the full hour to focus on just buying calls as far as the strategy is concerned, I think that oftentimes, like you mentioned, it's an alternative, right? We're thinking about our opportunity cost if we are looking to purchase a stock in comparison to buying a call. What is the, I guess, benefits or drawbacks of those two different types of products, and being able to recognize that, off the bat is helpful. But then also, as you were mentioning about the time frames, if you're, let's say, confident or bullish on a stock position going up, and you're not sure it's going to go there in a straight line, and week over week you're not real sure, but you're targeting that over the course of the next year or 2 years or 5-year time horizon, I think the stock is going to be a big winner. That's not necessarily the outlook that is going to perhaps draw a direct parallel for a beneficial buying call strategy. And reason being is that the kind of limited in expirations, some of these expirations, don't get me wrong, go out a year, 2, 3 years. So there is the ability to go out further in time. But if you're not so, I guess, convinced as to the time frame for a directional move to happen, how much of a move, what the magnitude is going to be, then sometimes buying a call in comparison to the alternative of buying stock, or potentially some of those other strategies like we had mentioned might actually be better suited. And that's always going to be in hindsight. There are also a couple other questions that I wanted to try to answer here kind of on the fly. So let me table over to Active Trader Pro for just a moment. And then also I'm going to switch back over to kind of a different set of slides that we had, but I think some other information that's pretty helpful on trying to gauge this conversation, especially if you're thinking about it from the kind of stock alternative standpoint. Up in front of me, a chart of Apple trading at about $217 and change. And a question came up about the percentage of calls that finish in the money on kind of that third Friday expiration. And Ray, that's a great question. It's probably a question I know for a fact I probably asked, teacher, or kind of asked myself back in the day. Couple things to consider that I wanted to point out, folks. Within Active Trader Pro, which is where I'm working now, this is what's called an options chain. It's pretty blank because I still need to select different expiration dates as they're called. What Ray is driving at is that the typical standard monthly contract is there on that third Friday of the month. So if you're looking at this kind of September 20th date, or October the 18th, or if you remove these weekly options, which are now getting much more popular for different products. This is more or less what a options chain I looked at when I was learning the game quite some time ago, with these standard monthly contracts, kind of near month, next month, and then cycle months as they have them. But in this day and age, there are also different expirations that are not just limited to those standard monthlies, but actually weekly contracts for some products and even daily contracts as well. So I wanted to bring that up just to keep in mind that with the landscape always changing with the options trading market, do recognize, of course, and may go without saying, that there are also additional expirations that are available. Now, more directly to your question about how many calls finish in the money, I got to admit I don't have any percentage on that. But the other thing that this is not limited to, when we talk about a call finishing in the money, that does not directly correlate to you making a profit off of your trade. So do keep that in mind. When we're thinking about a stock or a option series being in the money, of course, anything that's shaded kind of in this gray area for this option contract series currently in the money, meaning which would you rather be buying at? 215, 212, 210? Or would you rather, quote unquote, be buying at 217 spot 92 in the open market? Well, quote unquote, you would rather be purchasing at the cheaper price, and there's still a cost of doing business. But that's how we think about calls being in the money. And if you're thinking about, well, how many calls finish in the money, I mean, bear in mind, we only have the top 10 shown. You can show 20, you can show all. There's going to be call contracts that go all the way down, probably to $5, $10. Doesn't mean that they're traded a whole lot, but do just keep in mind when we're thinking about in the money versus the ability to try to turn a profit, that's all going to come down to what it was that you had purchased your call option for. And then in relation to what you're either able to sell it for, or what would be called exercise takes place. I think I saw another question about that, and Albert, you might have already answered it. But for the audience out there, if you are a buyer of options, I know we're here to talk about calls, but if you're a buyer of a call option, it is your right to exercise, meaning that you would, if you want to exercise, actually say, hey, Fidelity, I want to exercise my $215 call contract. I actually want to purchase 100 shares per contract at 215. So go ahead and exercise that contract. There's going to be reasons why trading out of your option, you might be better served. But if you wholeheartedly do want shares of stock, the exercise notice is what you have the right to go ahead and do. So I wanted to go ahead and clean those up. Ken asking a question, or maybe you've making a statement: the deeper in the money you buy, the less likely you are to lose all your money. I think I could agree with that. The wheels are turning slower than they used to in my advanced age. Albert, let me maybe take a stab at this. I do want to show some slides, but your thoughts on this as well. Ken, when you're thinking about the less likely you are to lose all of your money, I think the reason I agree with that is this. Let's say that you just going to go all the way down to a strike of $150, up to about where we're trading at now. Call it this 220. If you were to buy a very, 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 very deep in the money call contract, losing quote unquote all of your money. Well, if you're looking at kind of your entire investment, call it $68, okay? What would it take for you to lose all of your investment on these 150s? Well, Apple stock would need to go from the 217 it's at in the next 11 days down sub 150 so that this is an out of the money contract at this expiration. So the deeper in the money you go, the less likely you are to lose all of your money. I think you could make a pitch for, yeah, that's probably true, because you're going deeper and deeper, deeper in, you're spending more and more and more. So what's the chance of you losing all 100%? Well, probably not as high. However, is it going to hurt by a serious amount? Even if the stock doesn't get down to 150, if this stock was to retrace down to 200 or to 180 or to 190, whatever that price point may be, that's what I think is a good foray into our discussion on delta. When you're looking at a delta, that's also another shorthand for being able to think about what's the kind of option market participants pricing in, or kind of statistically thinking about this contract finishing in the money. Whereas the other way to think about delta, and probably the number one textbook definition, is for every dollar that Apple moves, it's every dollar that Apple stock moves up or down, how much should I expect theoretically my options price to move up or down? And when you're looking at delta like 99, what that should tell you a nominal standpoint, much less maybe from a percentage standpoint, in comparison maybe to the alternatives of something perhaps closer to the money or not so deep in the money. So that's probably more long-winded than I needed to be. Albert, you got any maybe more refined or clarified way to think about that? I don't want to be so catty to think, oh yeah, go deeper in the money, you won't lose all your money. But the deeper and deeper you go in the money, just recognize that if there is a move that directionally goes against you, it's going to quote unquote hurt, I think, and sting quite a bit given these high deltas.
Yeah, I think that's exactly right. I mean, as a trader, we're always trying to find the easy way to think of things, and I think that's, certainly true on the trading floor where I spend a lot of my time. But when we talk about deltas, we can look at delta as the percentage chance of it finishing in the money. That's the easiest way to think of a delta. Doesn't mean it's going to be true though, right? The problem is that as Peter is kind of laying out, is when we get to these higher delta options, they're going to be more and more like the underlying itself. So in other words, we're talking about a 99 delta or 98 delta, then that stock is going to behave much like 99 shares of stock. And so if we have a big drawdown, it's going to go down quite a bit more than maybe say a delta of 20 or 30, for example. So on a percentage basis, you would probably lose more. Maybe you don't lose more on a dollar. We could certainly map that out and take a look at it. But I agree with basically everything Peter said. Yes, you could theoretically think of it that way, but don't be fooled to think that it's less risky, because I would certainly not make that distinction with regards to deep in the money options.
Okay, perfect. And I think that's a great question, Ken, for what you're, mentioning here. Let me move over to part of the slide material that I had from a separate deck, as well. And I think that is more back to the slides actually about that conversation. It's so important that we have a material specifically built for it. And it gets back to strike selection. So when we're thinking about strike selection, important factors are the cost or exposure. And in a nutshell, that's really what Albert and I were just discussing here and now. You're thinking about Delta being able to provide that, insight to your directional bias, or maybe the, conviction, or aside from bias or conviction, really the way I think about it is kind of how much of that move here and now are you trying to take part in versus maybe a assumptive move perhaps down the road, because these deltas do dynamically change. So here in this example, when we're talking about cost versus exposure, I think what this slide is trying to go ahead and demonstrate is, in our example, we're kind of at the money, deltas are going to be closer to 50. Deeper in the monies, like we had just seen, are going to approach 1, and those further out of the money deltas are going to be lower, closer to 0. Well, as you can tell, you've got, in this instance, the ability to try to get a delta at about 80 or so, and your bid ask is about $5.55. So you're spending about $5.55 for 80 deltas. Whereas if you were to go, let's say out here to these 42s, okay, well, if it's costing you 550 or so to get 80 deltas, why not just come down here? And if you want that delta exposure, kind of that share equivalency exposure, some traders might say, you know what? I like the thought of having 80 deltas, but I don't want the in the money. I want more of the characteristics of the out of the money. And it's only going to cost me $1.60. So actually, I can buy two of these for $3.20. So I'm doubling this, or instead of buying one contract here, buying two contracts here in this hypothetical example, you're shelling out $3.20, still saving part of your investment and giving yourself the exposure now to twice this amount. So 82 deltas versus the 79 that we were seeing with these deeper in the money contracts. Now, what are kind of the differentiations there, or why might you not want to do that? Well, if you're going to get that benefit and it's going to be cheaper, one, it's out of the money. Secondarily, what you're going to observe is your theta is going to be a little bit different. Your time decay, the time value. You're looking at intrinsic value versus purely extrinsic value for these further out of the money contracts. So the rate of decay here, rather than with the single contract being about 3 pennies or just shy of 3.5. If you're doubling the deltas, you got to double these other metrics also. Now, rather than losing on a day over day basis, all things equal, about 3 cents or 3.4 cents, you double this figure. Now you're losing 8.3 cents. So you're doubling your delta exposure for a little bit cheaper. However, you're also doubling that theta headwind that you have. And now your investment of that $3.20 or so, losing about 8.5 cents versus the 3.5 cents that you might have if you were at these in the money contracts. So that's kind of a quick example when you've got these, as Andrew likes to say, kind of the gimmies and gotchas. I like to say kind of headwinds and tailwinds on the grand scheme of things. What's working for you? What's working against you? There are no shortage of different combinations of option strategies that you can do to try to give yourself those desired characteristics. It's just going to be up to you as to which ones you think are going to be more beneficial. And I think that also goes back to what we discussed before, kind of in my, ho-hum example of, yeah, I'm thinking a stock's going to meander its way higher over the course of the next year or two. A contract that goes out a month, probably not going to be the one that fits the mold. If, however, you're thinking that there's going to be a pretty sharp move higher in short order, maybe you can withstand the theta decay that you're going to have because you really only plan on being in the stock for a week or two, which is why being able to get your desired deltas and weather the storm of any type of theta decay might be what is worth it for you. I think that's what this next slide does, kind of the approach that you want to take. And I know it says typically. I think that's a good word there just because you don't have to pigeonhole yourself into doing the same strategy. You don't have to say, I always buy out of the money contracts or I only ever buy in the money contracts. I think there's going to be different outlooks that you have that maybe you want to dial up your exposure. I think what we're really trying to illustrate here with this example, as we had seen in that live example with that Apple scenario, deeper in the money contracts, nominally you're going to cost more. You're going to be putting more capital towards that trade, all things equal, than you would for an out of the money contract, which makes sense. And what are you gaining from that? What's that delta exposure that we talked about, those higher deltas that you actually have at your disposal? Whereas on the other side of the spectrum, out of the money contract, now you have less of that directional exposure. At the onset of that trade, your deltas are less, but hand in hand, you're not having to put up as much. So your risk of loss is going to be much less, or I guess I should say the maximum loss, all things equal, buying one in the money versus one out of the money. Well, less capital is going towards this trade. So, potentially it's acting less like stock, all things equal, than the in the monies were. And the at the money's going to have a little bit of both. They're going to have the highest amount of time decay. They're also going to have the highest acceleration rate. That's what we start to think about when we think about these kind of a second level, or I guess gamma derivatives there as well, showing if you've got delta exposure and then that increasing delta exposure, which I think in the profit loss calculator is probably the best way to try to iron that thought out. Here's a part of what we're talking about with the gamma. Gamma, folks, is just the effect on delta for that change. So what makes those deltas go from the 50 at the money to the 99 for those deep in the monies we were talking about? That's gamma. That's kind of the I guess push or pull getting delta either to or approaching one, or down to or approaching zero. So when it comes to strike selection, we just talked about that. I think expiration selection is kind of the next thing that we would think about very quickly. Time frame for the trade goes back to my example. Am I thinking that there's going to be some type of catalyst, whether it's technical or fundamental, and that there's going to be a pretty sharp move in the next week, next month, whatever that time frame might be? Or is it maybe a longer term trade that you're considering? There are some still abilities to have, be maybe a deeper in the money, long call strategy out for, a couple years. But that does start to lend itself more towards a stock replacement style strategy, rather than maybe a quick directional move where you're really looking to try to get that more robust percentage return on your investment. So the things that you'll be considering, of course, time decay, like we talked about, is an event like a FDA approval and earnings, maybe some type of board announcement or something like that that's going to take place. And then also just recognizing that that price is sensitivity for more time. So are you going to be trading weeklies, maybe 1 to 2 months out, 3 months out? What types of expiration selection are you going to be maybe looking to try to get into? Option Greeks. This is more specifically for buying calls. If you are interested in the Greeks, some of what we've talked about so far, like Delta, Gamma, Theta, hadn't even got into Vega quite yet. I believe on Wednesday, I want to say Constantine and I are going to be doing a demystified Greeks session. So I'd really encourage anyone who wants to learn more about the Greeks, or at least get a good refresher course or maybe intro to them, to visit that. But what we're looking at here are the dynamics for buying a call. More specifically, if you're buying that call, you have that positive delta exposure, meaning that if you've got a positive signage for delta, that means you're bullish. You want this stock position or underlying to be moving positively. Negative theta, we know that if you're a buyer of options, you're paying for some type of time premium. That time premium is going to decay over time, which is why this negative sign theta is working against you. Now you've got your positive gamma, you've got your positive vega as well. Positive vega showing that an increase of volatility is going to be a tailwind and be additive to your options premium. Although do keep in mind, when we think about increased volatility, if you see the implied volatility of your position is moving up and higher, then that's what's going to be that tailwind. If that volatility actually becomes realized and turns into a position that's down 5, 10, 15%, obviously that directional move is going to be detrimental given the delta exposure that you have. So Greeks are just a way to try to quantify or express the risk that we're taking, or dynamically how a unit of change for a stock price or for a calendar day coming off or for a change in implied volatility is going to change. John asking slides for Wednesday. I will look. Truth be told, John, I used to have a kind of a rundown of those different sessions that we had. Option Greeks or Greeks demystified might be a search keyword. I'll try to take a look in the background after I pass it back over to Albert in just a moment, and try to show you that slide deck. And if not, I'll definitely try to have it found by Wednesday. Albert, I had maybe just a couple other of these trading pitfalls. I hate to be so much in the weeds with the actual material slides themselves. I know that we've got a lot through the profit loss calculator, maybe through some chart work. Folks, if you've got maybe a trade idea or something that you want us to try to refine or look through, let us know. But Albert, did you have anything to add here, at least for a minute or two?
Yeah, I think this is a couple of important things here to take a look at, and we'll jump into the demo here shortly just to kind of get into this. But um, remember that the out of the money calls have a low delta, right? Now, the allure, again, getting back to why people buy options or calls specifically versus the underlying. The allure, of course, is the less capital outlay. And then to take it even a step further, a lot of people are attracted to those low priced options because, hey, I'm only spending $100, or hey, I'm only spending $200 for this particular option. That's the most I can lose. And that is true, but remember that when you have a low delta option, when you have a 10 delta option, think about what it's going to take for that to move Think of what kind of movement you have to see in the underlying for that to actually start to move. The issue is that if you don't have the timing right and you're buying strictly low delta options, it may not have enough time for it to move and actually make any money before it just kind of decays and doesn't go anywhere. As we get closer and closer to expiration, it's going to be more and more difficult for those low delta options to start moving. Now, that being said, if you're buying them around a binary event like an earning situation, that could be a different story, of course. But just understand that when you are buying those low priced options, they're low price for a reason, right? And there's a good chance that maybe they don't end up anywhere near the money. Now, that doesn't mean you can't maybe make some money on that particular option in the interim, right? It could certainly go up from $1 to $1.50. You could cash out, no problem. But just be aware of what it is that you're dealing with when you start dealing with those lower delta options. The other thing that's important too, and this kind of goes back to that first one, is not accounting for the implied volatility. And I think that is going to be one you really have to make sure that you understand because it's going to make a dramatic difference in the price of your option. And I've got a pretty good example that we can kind of look at real quick. I'll grab the screen here, Peter, and just show an example that I have. I was starting to look at here. Um, so I'm going to go to Active Trader Pro, and I'm going to use Apple just because I know it's in the news today, and I'm sure people are familiar with Apple. By no means am I recommending Apple. I'm just saying let's take a look at Apple for a good demonstration. So let's just say that you watch the presentation today. You're seeing this is down 1.2%, but you're thinking to yourself, you know what? I don't really think long term, or certainly not in the short term at least, that this is going to be something that's going to continue to go lower. I'm looking at this technical analysis. I've drawn my Fibonacci lines here. I think that it holds at this Fibonacci level and starts to maybe work higher from here. So for me, I think I want to look at buying a call on Apple. Great. Okay, now you've established that. Now let's go to the actual option chain itself. So the first thing you're looking at is you're trying to figure out what expiration to use. Now, right away, I want to draw your attention to something on this option chain that should, at the very minimum, be a yellow flag. And that is, of course, the earnings, which are slated to come out on Halloween, no less, for Apple. So what does that mean for you? Well, that means that if you're looking at options today, you can look at a couple of things. I'm going to just reduce this to 5 strikes just so we can get a little cleaner look here. But let's just say you're looking at 25th right before expiration and the November 15th right after expiration. So the thing I want to take a look at is what does this look like compared to each other? In other words, the October 25th does not include the earnings release, right? It expires right before it. November 15th will definitely include that. And in fact, once we get closer and we get a new weekly, we'll probably have a weekly that comes in right after this and include the earnings right there. But look at the difference, right? We have right now, if we're looking at, say, something near the money, the 220 call, the volatility levels of this particular one versus the volatility levels of the one that actually captures the earnings. Now, this isn't a huge difference yet. It'll probably be bigger when we have an actual weekly that comes in after this. But those are going to be something to keep an eye on because a lot of times what we'll see with volatility levels is that they'll ramp up into earnings and then fall off after the fact, right? It's buy the rumor, sell the fact type of situation. So, and I'm sure Peter could back me up on this one. On the service side of things, I had many conversations with people who had said, listen, I thought the earnings for XYZ were going to be fantastic. I bought a call. I was right. The stock went up, but my option is worth less. What happened? Well, that's volatility. You bought into a high volatility level prior to the earnings, and now you're still holding that option as volatility basically crashes after the actual event itself and leaving that value of that option much less than you had thought it was going to be. So that point on the other slide that Peter had about understanding the volatility levels, that's going to be key to really any option trade that you would do, whether it's single leg options like calls or multi-leg options. Understanding those volatility levels is going to be important to determining whether or not you could potentially have success. Now, it doesn't mean volatility can't go higher, and certainly you would love to see it go higher. But in a scenario around earnings specifically, it could be a little bit tricky. So just a public service announcement, be aware of when those events are occurring, those binary events. Even today was a binary event, right? With the release of the iPhone 16. It could have gone quite differently for anybody that was maybe holding these September 13th options. Nonetheless, just be aware of those levels of volatility and what could potentially affect it, because it will affect the price of your position. So let's go ahead and assume that we're looking at it and we don't want to mess with the earnings. We actually just prefer, maybe just dealing with something that is done and over with before the earnings. So again, really a short-term mindset here. We're thinking that if we go back to the chart, let's say that we think that it could easily go from its levels currently to start approaching maybe this other high point that we got to at 230. So now we're thinking uh, between now and October 25th expiration, we think we could probably see a movement from where we currently are around 218 to roughly about 230. So now we can take a look back at the option chain that we were talking about. And now we can look at something, well, we can look at a variety of things here, right? We can look at the 220 call, which would be sort of at the money, trading around roughly $8. We can look at the 230 call, which is 10 points higher and really kind of our target at $4. And we can look at let's say we'll look at the 210 just to keep things even, which is currently trading around $14 and in the money. So let's see what those would maybe look like with regards to performance. So I'm going to pull up one more thing here. That's the profit and loss calculator for Apple. So let me expand this. This is nice because what you can do here is you can add simulated positions. So I'm going to go ahead and add some simulated positions for us. And I'm going to add this call. I'm going to buy to open 1. I'll do the expiration that we talked about, that October 25th. I'll do a strike price of 210 that we talked about. It's a call, of course. And let's just make it nice and easy. We'll leave it at, we'll say it's 14. We'll say something in the middle here. So I'll hit apply on that one. I'm also going to add the at the money, which was, of course, that 220 call. So I'm going to buy to open 1. Expiration is October 25th. The strike price this time is going to be that 220 strike price. It's a call. And we'll say $8 to make it nice and easy, because we like easy. And finally, I'm going to add one last one. I'm going to add that other one that we talked about, the out of the money. So again, buy to open 1, October 25th. Strike price is 230 this time. It's a call, of course. And the valuation price, we'll say this one is 375, just to make it nice and clean. All right. So now we've got our 3 options that we've put in here, the 210, the 220, and the 230. So let's take a look at some potential scenarios. Let's just think about, for example, let's say that we're right and the stock starts to move. Now, the nice thing about the profit and loss calculator, before we even jump into this, remember when I started off talking about the things that could affect the strike price or the option premium? Of course, it's the movement of the underlying, but the other 2 factors that you have to consider when you not, as opposed to stock, is that time expiration and that volatility level. So you got to keep those in mind when you're dealing with options. The nice thing about the P&L calculator, it gives us the ability to do just that. We get to work with those 3 elements and determine how those would affect the price of our options. So let's go with the situation number 1. Let's say that between now and we'll go out a little bit further. We'll say that really the stock hasn't moved. We're going to put the stock at 220. And we're going to say that this is going out to, we'll say at the roughly the end of the month, to the 27th of September. And nothing else has changed really. So here we are, we've moved out to the 220 is the price. It's the 27th of September, as we can see down here. And let's see what has happened to our position. So if we take a look at the 210 call, right, our basis right now, we paid a price of 14. It's currently worth 13.31. So we have a theoretical loss at this point of $68.87, right? Nothing's happened. It's moved up slightly, but really nothing has done much with regards to at least the outlook that we had in that time frame. So we've lost some money on this one. The 220 call, the at the money, again, we evaluated $8. It's currently worth $6.65. So we're down about $134 on this particular investment. And again, we haven't really seen much movement. So not surprised to see us losing money on these. Of course, the 230, we only paid $3.75, but it's worth $2.50. We've actually lost even more on this particular one from a dollar amount standpoint, right? As opposed to we did the deep in the money. So this kind of goes back to the original part, like we were talking about. I think it was The question was, if you buy it deep in the money, it could potentially lose less of your money, potentially. And this maybe is a scenario where that would be kind of the takeaway, right? We've only lost a little bit versus even more for some of these that are further out of the money, even at the money, of course, the most. So let's take this a step further. Let's say that the following week, we'll say that the 4th of October. Now let's say it starts to move. Let's say we get actually to 230. And so now we've got our stock trading at 230. We've actually purchased these three. And again, we're going to take a look and see how we've done in that amount of time. We paid $14 for this particular option. Now it's starting to move up a little bit. It's at 21.15. So we've actually made about $714 here. And again, this is the one that's the deepest in the money. If we take a look at the money, well, again, we paid $8. It's moved up to 12.39. So we've made a pretty decent return so far, right? We've made more than half of our investment on this particular one. Same with the first one. And let's take a look at the third one, the 230 call. Well, guess what? We evaluated at 375. It's now worth 564 under these scenarios. And here we are making a profit of $188.82. So obviously, from a standpoint, if we want to talk about percentages versus the outlay, you can kind of see where things are laying. It's pretty similar for the most part, depending on how much you actually wanted to put out for that particular option, right? We've 1400, 800 versus 375, and the returns have all been relatively close, right? Somewhere around a little bit over 50% in that amount of time. But again, this is based on the idea that it's the 4th of October and we've moved to 230. What's it going to look like if we stay at 230 and we get to, a week before expiration? Well, now it starts to look a little bit different because that deep in the money that we bought, it's still maintaining a lot of its value, right? We've only lost a little bit from that 750 or whatever it was that we had a week earlier, 2 weeks earlier. But look at what happens to the at the money and the out of the money. So we've substantially less return on the at the money, and certainly the out of the money is actually down now because what are we doing? Well, we're a week away and we're at the strike. Remember, when we pay that 375, that's our break even. So in order for us to make money on this particular option, we need the stock to end up at $233.75 at expiration just to break even. And so if we're only a week out and we're still hanging at 230, we've only got 5 trading days to get there. And so now we start to actually lose money on this particular option. So these are the types of things we have to keep in mind when we're trading these options. What is our time frame? And if it doesn't happen in our time frame, what's it going to look like in this scenario? So again, if you were thinking it could get to 230, maybe you didn't buy the 230 call. Maybe you bought the 225 call or something. Keep in mind, if you set a target, don't forget, you have to make sure that you could offset the break-even point, right? So if you're buying an option you think it's going to 230, you're buying a 225, and you have to pay, whatever, let's say $4 for it. You have to get to 229 just to start making money, right? 229 to break even, above that to actually start making money. So these are the kind of things that go into the thought process of strike selection, expiration as well, right? Do we have enough time for our scenario to play out? How's it going to affect our strategy? So if we were thinking that this thing goes to 230 and it actually does that, it looks like their best choice is that deep in the money call versus the out of the money call. So that's just a quick scenario of 3 different ideas, strikes. Peter, I'm sure you've got some great examples as well. So any thoughts on this particular one or anything you want to add to it before we move on?
And I think, especially just given the time, sticking with your example for a moment, kind of rings true with something that I was kind of pulling up, and what you had just mentioned, um, the kind of the how to look back at what would quote unquote be best. I mean, we don't know that at the time of your trade, right? Which is like Albert's mentioning, being able to come in here and kind of map out not just what trade is going to be the best, but Albert, you probably know this from firsthand experience. Sometimes your best trades are the ones where you don't lose quite as much, right? You want to put yourself into a position where, as a risk manager, you're able to go ahead and try to get those risk adjusted returns, saying, hey, it'd be great to make, $1,000 on this trade, but if I'm going to have the chance to lose a pretty good amount, or if I don't have a high probability of making that thousand, maybe there's going to be somewhere kind of in the grand scheme of things where I want to be able to set myself up to try to have a higher probability to make 750 or 800, but perhaps only lose a fraction of that if this trade goes sour or south on me. Which is why I think looking at these alternatives, I mean, look at the stock, position itself. Folks, if you look at those deltas, that's what Albert and I were discussing, and probably not lost on anyone. When you see actual 100 shares of stock, that's a 100 delta. Now, when we're looking at those deeper in the money call contracts, those begin to approach 99, or like we're seeing approach 90 or get closer. That's what we talk about, that share equivalency. So some of you in the audience might say, well, Albert and Peter, I'm looking at that theoretical profit loss. And I mean, what one made the most money? Well, $800, the stock position made the most money. I don't have to worry about stock position ever expiring as long as Apple doesn't go bankrupt, knock on wood. I can just hold these shares in perpetuity. And all of those arguments or justifications would be perfectly sound. It's when you're looking at the percentage return. If you're looking at an $800 return that you have on your basis of that, what was it, $22,000 or so, even with the pricing that we had observed there, that return that you're going to be getting on your investment versus that example of the deeper in the money, you're making $623, not quite as much as 800, but then you look at that from a basis of an investment that only cost you 1,400. That's when you can really start to see, okay, I like the thought of being able to try to take part pretty heavily in a directional move towards the upside. But I don't want to maybe shell out quite as much capital or have it chewing up as much of my balances otherwise, as I would be able to through the use of a long call strategy. And then, as Albert was working out here with this example, whether you want the in the money, the out of the money, I mean, whatever that's going to be completely up to you. And some of that is going to be hindsight. I think if nothing more, the benefit of any of those long calls is, the most that you can lose. Argument would say, well, I know the most I can lose with my Apple stock. It's that $22,000. But that's when you're thinking about, okay, if there's some type of maybe storm that you feel like is on the horizon. Yes, you're thinking it's going to be, sunny skies and that the stock is going to make its way through this turbulent time. However, if you get that direction wrong, maybe you're thinking the stock could really suffer to the tune of 10, 15, 20%, whatever that number is going to be in your mind. That's when also utilizing maybe some long calls as kind of a stock replacement so that you know what that maximum loss for that time period is going to be. Might be, something to keep in your back pocket, if nothing more. And that way you'd be able to weather the storm with your maximum drawdown in mind, versus having to kind of look at the gap down exposure about maybe a stock that opens up 10-15% lower. You didn't really have the chance to try to get out, even if you did have some type of stop in place for your underlying security itself. Doesn't necessarily mean that long call is going to be a profitable equation, but I think that just goes back to sometimes when your best trade is kind of losing less otherwise than would be making quote unquote more. Let me maybe transition over for a second here. I know there was a couple questions that were coming through here. Venu and some others asking about a stop loss on a options contract. And it is possible. And Albert, I know you've got some thoughts on this as well. Let me grab the screen for a minute and just kind of share some of my thoughts on it. In practice and working with clients that had this question, it is possible in order to try to go ahead and actually set up a stop order on an option. So just to kind of walk through how that's done, I'm happy to go ahead and do so. Let me go ahead and maybe just get these strike prices that are closer to the money. But do keep in mind a few different things. One, liquidity, as with any type of trade, is going to have a lot to say towards being able to efficiently get into or out of a trade. Also, the kind of volumes that are behind this, as well as the spreads. So if we're looking at a product like Apple, even going out 67 days to a November 15th, these contracts still have, thousands of contracts that are being traded. Now, if you were to, let's say, get into a position and then you're looking to sell to close, so you would have bought to open a position. And if you want to trade out of that, then you would be selling to close. And looks like ActiveTrader Pro is a little bit slower on me, so I apologize. You've got the ability to come in with your quantity. You can look at these different stop orders and say, okay, if it's trading at 615 by 625, if it gets down to $6 even, then go ahead and place a stop in order to go ahead and get me out. You have the ability to do that, but, and I say but very heavily, do keep in mind, even the size here for what it is, you want to consider what the spreads are. You want to consider if you're doing this order as a day order, or if you're doing this order as good till canceled. You want to also consider you doing a stop where you're saying, hey, when it triggers, go ahead and get me out at whatever the bid is at that next available price. Do you want to incorporate some type of, stop limit? Where you're saying, hey, if it gets down to, $6, go ahead and trigger the order, but get me $6 or better, or don't get me out. There's a little bit more of a kind of a snag that comes into options pricing from a stop order perspective versus maybe how you would think about the underlying Apple. When you're looking at the Apple underlying, I mean, we're talking 49.5 million shares that have traded today. The stock price is moving up or down by a penny or two in either direction every single millisecond that's taking place. So there's a tremendous amount more liquidity, even with the underlying, in comparison to what it is for an option. Whereas if you were to think about maybe an option that trades much, much more infrequently on a name that doesn't get traded as much, I think, what was it? I want to say maybe it was Merck that was brought up earlier as an example of a symbol. If you go out to November, you might be looking at a contract that's got an 8 cent by 23 cent spread. Or maybe for some of these deeper in the monies, it's still a 35 cent spread. Even on a $16 product, that's still a healthy couple percent. So be mindful of the actual spreads themselves. I always say it's possible. Is it probable to be the best avenue or most efficient avenue in order to go ahead and get out of your trade? I think there can be a little bit of an argument there as to what might be the most beneficial. But as far as the actual trade setup, I think the last thing that I would mention here, Albert, is going back to the profit loss calculator. I didn't have the exact same trades that you did from a, kind of a hypothesis, a thought process. I just tried to go maybe 15 points in the money, maybe 15 points out of the money, as well as that stock that was already loaded up. And then just the effects of time as well. We talked just a little bit about that expirations. These go out towards December, folks. And if I just kind of reset this or take a look here, the kind of delta exposure, also the theta exposure that you have, and those kind of benefits and drawbacks. Do bear in mind that we use the terms a couple times. I know I did, I know Albert did as well. The delta exposure, the Greeks exposure that you have, the time that you're setting up the trade, it's going to be vastly different, a week, 2, 3 weeks later, especially depending if there's any type of directional move that's occurred. So if this stock price, let's just say, was at this $217, or tell you what, let's just try to get you a round number. Let's say that it actually went up to 220. I'll give it a few dollars. If it went up to 220 today, well, we can see what our kind of delta exposure is. And of course, the stock in and of itself doing what it's doing. Now, let's say that maybe a couple weeks pass, getting to the end of September, let's just say, see how these deltas are beginning to change. Your in the money deltas, all things equal, are going to begin to rise. Your out of the money deltas, all things equal, are going to be beginning to fall. And then we're going to notice and observe how these theta decays are going to change as well. So that's another, I think, big use for the profit loss calculators, being able to have kind of what I call these, unit measurement changes, either week over week. Look at these deltas, 80 and 40 with the thetas, what they are. Go out another week, theoretically 81, 39, go out another week and kind of see, okay, if this trade is starting to work against me, what are my profits and losses? And now you can see the deeper in the money contract, yeah, you're having to shell out quite a bit more, $25 in comparison to that out the money 770. But if you don't get that move that's heading in the right direction from that directional thesis standpoint, you're going to notice that these deltas are going to be beginning to fade a bit, and that time decay is going to begin to kind of chip away, all things equal, at a higher clip than the in the money contract would be. So that's part of what we talk about. Hey, what's the trade look like not only when it's going right, but potentially if things aren't doing what they're supposed to. And sometimes as a long call buyer or a buyer of options in general, sometimes not doing what it's supposed to can mean that a stock is essentially just sideways or flat, where then, of course, even though it costs you more capital to be purchasing the shares outright, there's no time decay for just owning those shares. It's opportunity cost to kind of an investment that maybe could have been doing better for you, but you're not actually observing the time decay coming out. And then not just the time decay component, but also recognizing this delta component for the further out of the money is really drifting to now if this doesn't really do anything for the next month or two, now all of a sudden you perhaps do have that move up to 225, let's just say. Well, your in the money contracts now have that higher delta. Those out of the money contracts have that lower delta. So if you were to be able to go ahead and get a move back, now you'll actually see that the in the money contracts are actually going to be perhaps at a bit of a theoretical profit, whereas you've gained back some of your losses from the out of the money, but it's not quite as much of a clip as you would have at the onset of the trade, just given how much time to expiration has already passed. So do keep that in mind. I think it's very interesting to kind of set that up and say, okay, if nothing happens for the course of a month or two, what are going to be my challenges? What might be happening, what might not be happening? And I think that's what begins to then get into trade management in order to tell yourself, look, I'm looking for a directional move to take place in the course of the next month or two. I want less time decay. So I want to go out maybe to the end of the year and give my trade, 3 months or 3.5 months in order to unfold. Even if you go out and buy something that goes out 3.5 months, 4 months, whatever it might be, you wholeheartedly might be thinking that you're only going to stay in that trade for a month or two. And if it doesn't happen by then, maybe you need to go ahead and manage risk at that point in time. So keep that in mind as well. I know there was a lot of questions that came in about kind of at expiration, what happens, exercise versus assignment. Do recognize that oftentimes these are tradable products from the options standpoint, and you're looking for kind of a move over a time period and then be able to manage the trade for better or worse. Albert, I'll leave it at that. We're 2 minutes past. I think this one was fun. We're able to go ahead through a couple different slide materials. We're able to go ahead and kind of open it up as far as engagement from the audience and different symbols that we wanted to take a look at. And we kind of both played on Apple, just maybe with them being in the news or the letters of the alphabet. But I always enjoy sharing the screen with you folks. I hope that you found some value in this. Not that you need to go out there and be buying long calls, but maybe there's a I guess, scenario or outlook that you have where a long call in some form or fashion might be part of your investment style or strategy. So certainly hope that that helps out. And Albert, I'll give you the last word.
Yeah, I think I want to, reiterate what Peter just said. This isn't the objective here wasn't to get more call option traders, right? The objective here was to give you another tool for your toolbox, and if the situation warrants it, now you know how to use it for that particular purpose. Understanding what the your outlook is versus how long it plays out will be key in selecting strike and expiration. So be aware of that. And then one last thing just want to kind of reiterate what Peter brought up about those orders, because I think this is very important, and I certainly want to make sure that everyone understands this. You can certainly use those types of orders. Just make sure you understand the actual mechanics of how it works, because you don't want to get surprised, right? You don't want to get a situation where you thought you're going to get filled with a stop limit and it just never happened and it just blows past you, or you have a stop limit that actually, or you have a stop order that actually gets filled, but well below what you thought because the bid and ask spread was so wide. So just be aware of those things. I like to say that option trading is a participation sport. So I don't typically like to do those things. I like to pay attention and kind of watch things where they are and place my trades accordingly. But again, if you're comfortable with the potential outcomes, by all means, you could definitely use those. Just make sure that you do understand that. That being said, thanks everyone much for being here. Peter, always a pleasure to share the screen with you as well. Hope everybody has a great rest of their day, great rest of their week, and we'll see you next time. Take care, everybody.